Hi, everyone. Welcome to the Timing Research Show for January 11th, 2016. Today we will be talking about the 120th weekly report from Timing Research. So if you haven't had a chance to take a look at this yet, TimingResearch.com/reports, and you can download this or any past report there. My name is David Kosmeter. I'm the creator of Timing Research, and I have Dave Landry hosting for me again today. So I'm going to go ahead and turn it over to him.
Thank you, David, and thank you to Timing Research for having me back once again. Jason, let's go to you. Jason Jakowski of theliononline.com. Tell us a little bit about yourself and a little bit about your trading.
Hi, Dave. Thanks for having me, as always. I love doing this show. And for those of you that are unfamiliar with what I do, my website is theliononline.com, and I focus on trader education and training with a master focus on psychology. I really feel trading is 95 to 99% psychology. I think that there's a lot of great stuff out there. There's a lot of great technical and fundamental methods and ways of analyzing a potential market opportunity. But when you really boil it down to the essential, it's how you tend to view it and whether or not you participate and how you trade and where you take yourself out and all that fun stuff. And for the most part, psychology, I think, plays a major role in everything involved in trading. So I focus on that, and we can talk all you want about my stuff as you need to.
Okay, fantastic. Okay, Greg, you're up next. Greg Weitzman from thetradingzone.com. Tell us a little bit about your trading and tell us a little bit about thetradingzone.com.
Sure. Hey, thanks, Dave. Good to be back. Always like doing these shows as well. It's been a while since I've been on, so it's good to be back. The TradingZone.com is an educational company that I founded in 2003, so we're into our 13th year. It focuses on education for active commodity day traders. So these are guys who like to trade actively throughout the day, scalp trading, multiple trades, anywhere from a couple of trades an hour to a dozen or so trades in a day. Our methodology stems from some floor trader systems and tools, primarily market profile. So that's the crux of what we do is embedded in market profile trading, and that's what I've been doing for the last 13 or so years. I've been active in the markets personally for about 25 years, and as an educator for the last 13 years.
Cool. All right, Glenn, you're up next. Glenn Thompson of PacificTradingAcademy.com. Tell us a little bit about yourself, your trading, and PacificTradingAcademy.com.
Well, yes. Thanks again, guys, Dave and Dave, for having me back. Happy New Year, by the way. Always a pleasure to do the broadcast, and glad to be here. I currently work with Pacific Trading. We've been teaching and in the educational business for, between 15 and 16 years now. I've actually been trading about 30 plus years, but working with them since their inception. And I teach primarily technical analysis. As far as my own trading, my own accounts, primarily trading the E-mini intraday and do a lot of Forex in the evening as well. Some of my coworkers teach fundamentals and other different aspects of technical, but I'm primarily focusing on the technical approach. I tend to agree in the limit with what Jason said. At the end of the day, I think whether it's fundamental, quantitative, technical, whatever, these are just labels to give us context. And ultimately, it's about the internal issues, which we typically put in that category of psychology, because it's the interaction of individual traders and the dynamics we call markets. So I place a lot of emphasis on what Jason said as well. So other details will come out of my approach as we go on, I guess.
Yeah, and what's the old Pogo cartoon? We found the enemy and he is us, or something like that. And it pretty much sums it up. Okay, I think that's everyone. My name is Dave Landry from DaveLandry.com. I like these other fine gentlemen here. I've been at this for a long, long time. I think I stopped counting around 20 years. My website is educationally based website. I have a lot of free reports on there. And when it comes to the markets, I think that you can only predict the short term. I think if somebody says, it's kind of fun right now, we're doing like, last week we did a forecast for where's the market going to end the end of the quarter. And, I threw a stupid number out just for S&Gs, and who knows. But you can look out over the next few days. Usually you can have a good idea or a good feel for what's going on in the markets, but it's very difficult to predict longer term. Now, it doesn't mean you can always predict the short term. I guess let me back that up a little bit. Ideally, you need some sort of setup in place before you do that. I have a 21-page report on the free reports if you're interested in that, and I also have about 1,400 YouTube videos out there, so there's plenty of free stuff to get you started, and then when you're ready to take the training wheels off, I have some more advanced products, and then I also have an online trading service. Let's go back to you, Jason. Based on any technical fundamental indicators you want to use, would you predict that the S&P 500 index will be higher or lower by Monday's close, and that's January 15th? And once you give me that prediction, rate your confidence to that by estimating the probability you have correctly predicted this week's market's move.
Okay, so if we're looking at where the market's going to be next Monday, not this Monday, but next Monday.
Friday's close.
Oh, Friday's close, right? Yeah, that's why I want to double check that to make sure. Because I thought I heard you say Monday. You know, I think we're going to be higher by Friday's close. I think that the whole issue that started the year, which I think is the fundamental issue, the market's focus on the fundamental issues with meltdown in China and a meltdown in the crude market and all that kind of stuff. I think that really threw traders for an emotional loop. It was unexpected by most, and people, I think there was a degree of panic in there, and I think that once all the dust settles, people are going to have an opportunity to resume their bullish enthusiasm for equities. Now, if you put a gun to my head and said, where are we going to be at a year from now or something, then I would say that I think we're going to be lower. I think that the U.S. economy's got a long way to go, and this is an election year. So I don't think there's a whole lot of money that's going to be spent before November. But at the same time, from where we are right now, like you said, short term, I think all the selling was a panic reaction, I think, and stock market slid for 4 or 5 days, and I think they're done now. And I think by the end of the week,
what's your confidence on that, Jason?
Above 80%.
Wow. All right, so I'll nail you down. I'll put 81 because that's above 80%.
Okay, yeah, I can't go much higher than that.
Yeah, that's pretty impressive. I kind of want to jump in, but I'll wait for my turn. Greg, let's go to you next. Based on any, you know the question, or?
Yeah, I got the question. That's good. So where do I think the market's going to close the end of this week, Friday? So let me preface it by saying that my core belief about markets and my approach to trading and everything we teach and do at the trading zone is based on the core belief, fundamental understanding that markets are never really in balance. We're always overbought or oversold.
Yeah.
Markets tend to never really stay in a happy place for very long.
Right.
So I think that what we're seeing right now is a dramatic oversold scenario. And I think that is going to lead to some buying opportunities and a nice snapback rally between now and the end of the week. So I'm fairly confident about this short term. Like you said, I can't predict out beyond that, especially the way I look at markets and I evaluate and interpret. I look at trading very similar to predicting the weather in a way that I call AccuWindow. I look outside, and if I see black clouds, I'll bet on rain, and if I see clear skies, I'll bet on sunshine. And that may change in 5 minutes.
You stole my analogy. Normally, I say that every week, but yeah, it's okay. That's good. I fully agree.
So I'm fairly confident. I'd say give me a 78% confidence rating on where we're closing higher than where we are now.
Okay.
The balance of the week, and if I can just continue what Jason said about looking out further, I think that the market is kind of stuck right now, and I think that we're not going to see tremendous gains between here and the end of the year. However, that being said, what this panic sell-off has delivered some great opportunity, because if we're flat, you have an opportunity to jump in and make back this chunk of the sell-off. I think ultimately we close the year in a year from now, a year less a week, about 2% higher than where we were in 2015, and I think that entire gain, that whole slim 2%, is going to come after November, December, after the election. So I think we're stuck in a range for quite some time. So if we're going to be stuck in that range, we have to look at the panic selling and the over exuberant markets and look for those overbought, oversold opportunities, and we have one right now.
Gotcha. All right, Glenn, let's go to you. Glenn Thompson, same question.
Sure. If rarely do I find, Dave, that my efforts at forecasting I see a number of parameters that kind of come together and make it easy, but this week it happens to be the case as far as my perception of what's going on. I'm going to say higher by Friday. I can't give you a specific price or even a range, but I'm very confident, more confident than I've been in the previous shows, that we're going to end up higher. I'm going to give that a 90% to kind of corroborate what I think it was Jason said. So I am very convinced we're going to be higher for a number of factors that I'll elaborate on in I guess the next question. But one point I want to make clear is I believe technically we're in a C wave of a correction from an Elliott perspective, and I think that from that wave perspective is an explanation for the price action we've seen coming into today. Since the top that came in at the end of December, I think all of that downward offering of the price in the broader market index is due to a long-term triangular C wave. I have cyclical components that suggest that's about to end within the next day or two, by the middle of this week. And so from my technicals, that would be the reason that I have. Yeah, it's always going to be some events fundamental. Last week and even now, it's primarily, I guess, the issue in Asia and China in specific, falling oil or energy prices, potential or the current tension, as well as further exacerbation of what's going on in the Mideast. But if it weren't those things, it would be
PG-13.
Yeah, it would be something else. So, but all I know is if I look at it from a deeper level, and I look at my area of research is timing, and I kind of work off of the premise that market's going to do what it's going to do only if and only when its time has come. So I'm working on the idea that I've got an aggregate of different cyclical components all colluding between tomorrow and Wednesday of this week and so I look at what the price act. When I said that this time seems to be fairly facile and easy in terms of my effort to forecast, it's because I'm seeing the price slide into my time point. Okay. If we had been, if say starting Thursday or Friday of last week, if we had been moving up, I'd be thinking about a retracement. I'd be looking at fib levels, trying to see, and I would therefore be looking at what I'm expecting to occur in the next 2 days to correspond to a market top. Alternatively, what I've been seeing since the end of December is a slide in equities into this window that I've projected, and I've got over 90% probability expectation it's going to correspond to a major surge in volatility and a trend reversal. So that's why, again, I can't predict a specific price, but I bet we're going to be higher Friday at the close than we are right now.
Okay. Well, you answered most of the next question for. I'm sorry. I'm getting a little bit of a delay, so my apologies if I talk over you. You answered most of the next question too, but when we do get back to the next question, if you would like, you could share charts. Sure. And maybe show us that C wave you're talking about, because I'd like to see that myself. I'm going to go ahead and give the answer, and I'm going to go ahead and answer the next question too, just to make it easier, since I already have my charts up and running and shared. I agree with all three of the fine gentlemen here that I think we're very oversold, and I think we're very much due for a bounce. However, as a trend follower, I have to stick to my guns, and I think the trend is down, and I'm going to stick with a down forecast as long as, at least for now, unless this market goes on and starts making new highs. Now, let me show you. We have a daily, what I call a bow tie sell signal working off of multi-month highs, and usually I don't get too excited about that kind of signal, but if you look at where those highs are, it's just off of all-time highs. And sometimes when you get the second or third signal up towards the all-time highs, it's what I call the second mouse signal. The early bird gets the worm, but the second mouse gets the cheese. And more importantly, and I've taken a lot of heat for this over the past several months, but if you take a look at the weekly chart, we had a weekly bow tie sell signal, and this is just where three moving averages come together and begin to spread out. If you go to YouTube right now, I talked a lot about it. The weekend charts, which is up there now, so just go to my YouTube channel and you can check it out. It's Dave Landry. But just real quick, that signal triggered back here. You wait for a little bit of a pullback, and then it triggered, and not much really happened. Market didn't sell off too much, and of course it went straight back up. But notice that it stalled short of the prior high, so that top remains in place, until or unless it gets taken out. Now, if we start trading 30, 40, 50% lower, then obviously I'm not going to wait for that top to get taken out because we might get another buy signal in between. And just real quick, I want to show you something here. If you back the chart way out, and again, I did a lot of this in recent videos, you had a sell back in 2000, you had a buy in 2003, you had a sell in 2007, 2008. These are weekly charts. And then you had a buy in 2009. It was a little bit late to the party in 2009, but the market more than doubled since then. So I think it's still a viable signal. Now, every top will have either this bow tie signal or one other emerging trend pattern that I follow. But not every emerging trend pattern will obviously turn into the mother of all tops. But I think it pays to pay attention. And my good friend Greg Morris, he used to run about $5 billion or more, somewhere in that vicinity. And he used to always say, we treat all signals as if it will be the big one. And I think that's where we are right now. I think you have to take it seriously. Yeah, I think we're due for a bounce between now and Friday, but I'm going to go ahead and predict lower as a trend follower who has a signal to be short. And I'm going to give myself a confidence of about 60% on that. So that's kind of a long-winded answer, but that's the developing events too. So Jason, let's go back to you. And the question that I just answered was, I guess for those who are wondering. And by the way, I'm 100% technician, so I'm not going to use fundamentals or anything like that. But the question is, what developing events, and they can be technical or fundamental, will you be watching out for this week that might have a positive or negative impact on the S&P 500 and other U.S. markets?
Okay, I think that's a great question, but I think that it goes back to what's already happened last week. You know, we have probably the single most bearish commodity on the planet, which is the crude oil market today, right? And crude today under $32 a barrel for West Texas, right? And can you guys hear that ringing in the background? Is that? There it is again. Can you hear that?
Can you still hear it? I thought it was
Yeah, I just figured it was someone's phone.
Yeah,
someone's got their mic open. That if they could turn that mic down, that'd be great. Because it's like right in my ear.
Yeah, sorry about that. It's
No worries. So anyway, West Texas Intermediate trading below $32, and we were, not even 8 weeks ago, $45, I think. That's the biggest commodity, most liquid, most heavily traded product, in the globe, other than currencies, is crude oil. And you've got that market down at levels where inflation adjusted and adjusted for the value of the dollar, all that kind of stuff. People are going broke trying to make money in the crude oil market. So I have to echo.
Unless they're short.
Unless they're short.
Unless they're short. Right, but that's a trader's market, is what I'm saying. Is a trader would be making money on a short sale. Everybody else is trying to find a way to get long or pump it out of the ground or sell it. You know what I mean? So I think it's a huge variable that is taking people's eye completely off the ball. And once crude bottoms and recovers, which it will, because I think I agree with the other guests that you had on earlier, or I'm sorry, not earlier with us, but came on a little later after me. I'm pleading ignorance here, and I'm really sorry. I think it was Greg said that the markets tend to overshoot, and he's absolutely right. And I think crude has taken just such a beating. When that market recovers, all the emotional pressure is going to come off the marketplace. And I think that if crude makes a move higher this week to correct the oversold condition, I think the equities markets will go right with it. I think they're at this point people are really heavily watching whether or not crude gets on the 20 handle somehow. And
yeah, it's amazing. Sometimes that's what makes this game so hard. Is sometimes crude oil going down is good for the market, and sometimes it's bad for the market. And right now,
it's horrible for the market.
It's bad for the market. I hear you.
Right. So if crude bounces, I think it'll take everybody with it, and we're way oversold anyway. And I'm really looking forward to seeing what the commitment to traders report is this week for crude oil, because if they're anywhere near record shorts or something, I just that's the best clue you could ever get.
How could they not be? I mean, it's pretty obvious trend, and we got burnt trying to. We actually had a buy signal not that long, well, a few months ago, and obviously it failed miserably. It rallied up a little bit, and it came right back in. And my feeling is it's always darkest right before it gets more dark. So,
well, yeah, but Steve, that's you and I both know that it's a finite universe. You can't. The minute it goes to a near record short position, the market rallies. 6 weeks ago, 4 weeks ago, they announced a record short position by hedge funds in gold. Record short. It's $100 higher now. I mean, you just can't. That's going to be the biggest clue you could ever get that the market has done. So I'm really interested in watching the CFTC report for this week because of crude. It's just if there's been a big increase, maybe we'll be a little bit lower. But if they're anywhere near a record short, you got to believe that market is going to rally, and it's going to rally hard because you can't. The markets look most bearish when they turn and become they rally, and the same is true with the highs. And I just think
the most amount of people, I think, as you're alluding to, are on the wrong side of the market, and that's why some of these transition patterns that I like to follow could work really well, coming off of major lows and major highs, and that's the first thing I recommend you look for is a major high or major low. I think I agree with you. When this market goes, it's going to go. Mike Moody has done a lot of work with. He's a friend of mine. He's in the AAPTA, American Association of Professional Technical Analysts, and that's where I met him. Saw him speak once there, and he did a really fine job. And he was talking about how stocks have no end-use value. So a stock could just keep going down. But something like crude oil has end-use value. There is some value to it. So if there was a way you could buy a whole bunch and save it, sooner or later, even if the price never went higher, at least you would have some oil, So I agree with you on that, and I think these commodities, such as crude oil, when they get just totally washed out like this, can really come roaring back. As a trend follower, I would stay short until it does, and they get knocked out. But yeah, the trend. I wouldn't try to catch that falling knife just yet. But I hear you on that. When it turns, it's going to turn big. Anyway, didn't mean to filibuster in on you.
No, it's all good. No, I know we're all got only so much time we can actually invest in speaking to give everybody a fair shot at their point of view. But I got to tell you, if anybody's that doesn't understand this business very well yet, if they can grasp the concept that everybody's already in on one side, there's only one way out. It's the other side order. If everybody's short, the only way out is for them to buy back the market. There's going to be a buy-side order flow imbalance that's going to be staggering in crude, and that's going to be.
If I can, can I jump in here with a quick commentary on that?
Please. I hope so. Yeah, please.
Yeah. Okay. Great. Yeah. I love your comments and your analysis, and I completely agree with what you're saying about crude oil, especially because $32 is a multi-decade support area right where we are right now. So this thing can come snapping back hard. But to your point about the correlation to equities, and one of the reasons I prefer trading commodities over equities is you look at the S&P 500 where you have 500 components that you have to worry about. And of course, something can do well and something can do not well, and based on the weighting, you can have a poor correlation to something like a crude oil equities trade. But when you look at single commodities, right now there's just a tremendous correlation between the Canadian dollar and crude oil. So if you're looking to trade something that is beautifully correlated, we've got the CAD pushing 70 cents right now, and as crude goes the Canadian dollar. I mean, it's our number one export. I say our because I'm Canadian. So if you're following crude and you're looking for something to trade as a correlation trade, I would encourage you to look at the Canadian dollar crude correlation because it's just been fantastic. And when that snapback happens, you can see a couple 100-point move on the Canadian dollar.
It's funny you should mention that. In my daily live trading chat room that I provide to my subscribers to my services and the people that buy my education products, I have a chat room that people can hang out in there. And one of the things that we've been doing for the last 3 weeks is looking at the short side of dollar Canada. And from where I can sit and see that correlation, just like you described it, when crude finally rallies, dollar Canada that could be 1,000 points lower. I mean, where we're at today in that relationship, I've never seen a market 99% correlated like that one has been. It's just amazing to see.
Well, what's amazing about intermarket technical analysis is that there are these great correlations or inverse correlations, but it only seems to matter when they matter. So I think I'll never get around to doing the research, but I think that'd be wonderful research to identify what you guys have already pointed out between the Canadian dollar right now and crude, and follow that relationship until it stops working, and then find another one, and keep an eye on it. But I think there's definitely some fodder for research there. But again, sometimes you might get a negative correlation or something, and it only matters when it matters. It's not going to be always this way, but that's how it is now. So interesting. Okay, Greg, did we get the developing events from you?
I'm not so big on developing events because my outlook is really technical and short term. So whatever the events are, they are, and I measure the reaction to them. So
Amen.
So if you pressed me for some stuff, I would give you something, but it doesn't really impact how I look at the markets. Right now, we're in an oversold territory. From a market profile perspective, we've been trading below the value brackets for some consecutive days. So that multi-day POC, point of control, on a 3-day basis is just acting as a magnet to kind of drive the prices back north. Short-term stuff, though, if I'm really pressed for a fundamental opinion, I would say that given the turmoil in the world, China, etc., it's going to help the snapback because the investors and money always seeks a safe haven, and there's no better place right now to put your money than the U.S. markets. Other economies are still holding their interest rates steady or lowering them. United States is talking about increasing the rates. That's going to help. You look at the how equities have been doing, even in light of some very difficult times. The U.S. equities have done incredibly well. Also, going back to that decoupling between the sell-off in crude and the U.S. equities. So there is a correlation, but it's not nearly as strong as crude to some other commodities, and that's why, again, the U.S. stocks is a good place to have your money. So on a fundamental basis, I still think that money's coming in, to the safety of the U.S. markets. And events, well,
We steal the dog, release fleas, I guess, huh?
Yeah, pretty much, yeah.
I'll be in China in a couple of weeks. I'll ask you when I'm there. Hong Kong, at least. I guess that counts as China. All right, Glenn, same question to you. What developing events, technical or fundamental, will you be watching out for this week that might have a positive or negative impact on the S&P 500 and other U.S. markets? And again, if anybody wants to share a chart, easy for me to say, feel free to do so.
Sure. Yeah, I'm following on the heels of what's been said, and I'm pretty much in accordance. I'm starting from the charts. Whatever that I want to always work from that standpoint of allowing the markets to kind of, or the chart, the history of the market to kind of lead me, and then once I work out or project some type of plausible scenario, look to what types of events fundamentally are presenting, and then try and see if there's some reconciliation points there. So in terms of where we are at this point, I think China is the biggest fundamental factor. So if I look at, I think what's going on, if I think about that fundamentally, and again, I'm starting from the charts, so I kind of have to go outside of my area, but I guess you've got a scenario of Chinese deflation. So I look at in terms of, and then the currency being, there's pressure on the yuan right now. So I look at the chart of the yuan, and I try and then figure out where is it, say from a descriptive standpoint. I think we're nearing a bottom there in the yuan, or a top in the U.S. We're not there yet. I think we're going to see continued strength. Following on the heels of what Greg just said, I think the U.S. is the good place to invest right now, and I like the dollar, but I think we're nearing the end of that, and as such, that would suggest an ending in the devaluation of the Chinese, and I think that will tend to be the solution for the problem plaguing our U.S. market right now. And I also agree with the intermarket correlations that were just alluded to with Canada versus the situation here. The big things this week are oil. The slide there, from a pure trend standpoint, it's hard to buck the trend. I don't see that going much lower, but I was saying that at $36, $37 a barrel.
Yeah.
So I'm almost.
Yeah, I'm embarrassed to admit, but I threw it out there. So I was in a webinar a while back, and it came up. My daughter and I passed a gas station, and ever since she's been this big. She always points out what the gas prices are. I don't know why. I guess, being my daughter, watching commodities. But yeah, I bet her. I said I bet we'll see like over $2 before we see it below 185. And so I owe her $10 because it's I think 169 last time I passed that particular gas station. But yeah, it's like things could always go lower. Just because they're low doesn't mean they can't go lower. So as a trend follower, I'm embarrassed that I made that bad bet.
Yeah, I don't know, Dave, did you mention you were talking, or somebody said, it was either you or Jason, I think, who said, well, we want to wait and see what the COT report is Friday. One of the things I look at is when you have an atypical disparity between where the commercials and the small specs. Rarely do you see, more typically you see the hedgers, the funds, and the commercials at kind of opposite polarities. I would say 15 to 20% of the time you have the small traders at odds, polar opposite. When I see that, that's a strong indication the market's about to reverse. I did a trade just about a month.
You cut out on my end. What was the? So you want it? So if it's mostly small traders, then
whatever extreme the commercials, wherever the commercials are, normally 80 to 85% of the time you got the hedgers, the funds and the commercials polar opposite in terms of their net positions. When you lose that relationship, and instead you normally that's the normalcy. When you see the small specs who got it wrong 85% of the time, let's say, when they are at polar opposites to the positioning of the commercials, that's a strong correlation I've found across sectors where you see a trend reversal in the underlying. So I did a situation, if you look at in orange juice, that rarely happens, and although orange juice is a very illiquid market, and I don't recommend it, there are some scenarios where, again, 15 to 20% of the time you see this relationship, and it's a very strong indication for a market turn. I don't see that yet in crude, so that's why I'm still suggesting there's further downside there. One factor, not the only factor, but when you see that, when you see the small traders move into opposite, kind of a mirror image in terms of their positioning relative to commercials, watch out, the market will turn.
Gotcha.
Can I just segue with what he just said?
Yeah, jump in.
Okay, real quick. One thing I've noticed about the exact same phenomenon you just described, I call that the late participant.
Mm-hmm.
In other words, that everybody is short, everybody's short, all the shorts are making money, and then you get that one report where you see that flip, and now the commercials are either liquidating or going the other way, and we're getting a big increase on that final group of shorts. Those are typically really small accounts, and when I say really small accounts, I mean these are guys with their last few $1,000s buying options or trading minis. So one of the things that I noticed that was very helpful to try to time that as well as I could is to look at the hourly volumes when that happened. So when they do, in other words, when they do let's say that this Friday, the Commitment to Traders report says that happened. You got a large amount of speculators went late short. All of a sudden that they flipped like that, like you just described, right?
Mm-hmm.
I would go back and look at today's volume on an hourly basis, tomorrow's volume on an hourly basis, last Friday's volume on an hourly basis, and what I'd be looking for is I would be looking for below the bottom third volumes at like breakdown points or when the market tested support or resistance and went through it. The volume there didn't really go up. And if there was any way you could get somebody that had back office or was a computer programmer that handled order flow in the markets, any friend or buddy or somebody you can pick their brains on, find out if you can get ticket size. So when you see sometimes, you know what I'm saying?
You're just about describing our market profile methodology.
Yeah. Okay. Well, that's good. Yeah, perfect. Well, you understand exactly what I'm saying, but
right. We're basically looking all day long. We are measuring the relationship between the institutional and the non-institutional traders,
right.
Specifically on the half hour and on the hour, because that's when the institutions come in with their orders.
Right. Exactly.
Yeah, so we'll use the various market profile levels, value area highs, lows, and prior days highs and lows.
And look for the volumes there, because
look at the volume, exactly.
Small people trading, small accounts trading,
exactly.
right?
And
then the Johnny-come-latelys or the fickle traders, and they just they're just going to rush out the door as quickly as possible, and that's going to be your first catalyst. But it's what happens afterwards is going to be interesting.
Well, that's why markets don't go straight up or straight down, because there's going to be you get 29.90 print. There's going to be some professional short covering there, so you could get a $6 rally and have it fall right back to $30. So we don't know what's going to happen until it happens. But what I'd be looking for is that what I call the late participant, the late seller, the late buyer.
What's the IV on the options as opposed to historical? Is anybody looking at that?
If you're asking me, I wouldn't know. I don't track it.
Anyone else? That might be kind of an interesting thing to look at.
Yeah, I don't know, Dave, but
talking about the
that's
VIX,
going to be revealing. Yeah.
the generally on the VIX or on a specific?
Well, yeah, just your implied volatility versus the HV of the underlying, just to see how crazy it is right now, because I would imagine that it would be kind of out of whack.
Yeah, I don't have the numbers in front of me, but it actually stabilized this morning somewhat. There was a huge spike on Friday. That is not something I normally watch. I just don't have the stats in front of me.
Gotcha. Okay, good conversation as usual. I always learn something here, and that's one reason why I show up. So, the question of the week this week is: what percentage of your trading account do you typically put into a trade? Easy for me to say. And let's go to you first, Jason.
Okay, I have a somewhat different method of trading my personal, and I'm going to start publishing this. So those of you that are listening, not sure what I do, want to learn more. Sometime, not exactly sure when, but in the next week or two, certainly by the end of January, I'm going to start publishing what I do in my actual live, real-time, real money trading accounts. I'm going to put together 2 model accounts and show people in real time what I do and how much percentage of equity I use and when I execute and why in real time, so people can get a real good idea about the value that I can offer them. And one of the things that I do that's different with regards to equity and management and positioning with leverage, one of the things that I do different is that I don't try to form an opinion about the actual market price action or direction. I look for the signal that would indicate a higher than chance probability, and then I put the trade on. In other words, if I believe the market's due for a reversal, I'm looking for the place where it goes, okay, it went a little too far to the downside, and this is a signal that maybe we've got at least a lead coming on the market. Now, that may not mean it works, but we may get a bounce there. And so when I do that, half of my money is allocated to the long side, let's say, and I'll put a small position on the long side and manage just the long side as if that was the only trade I had operating. If I get the exact same relationship to the short side in the exact same market, then I'll put that trade on with the other half of my money and manage that as if I didn't have the long side on. So I'm always in the market either on one side or the other, or for a period of time both. And the reason I do that is because I don't want to be in a position where I have to form an opinion about prices. So my leverage is typically half. In other words, if I have, let's just use for sake of illustration, $10,000 to work with, I'll have a $5,000 long-only account, and I'll have a $5,000 short-only account. And if I'm trading, dollar Canada, I'll be looking at every short potential that comes up, and I'll put one position on in there. And if I get a buy signal in the same market, dollar Canada, I'll go long as well, and I'll manage them with the same exact money management rules. So what will end up happening is, if it tops, the short side works. Whatever I lose on the buy side, I make back, plus hopefully a gain on the short side. If the market continues to trend in the same direction, I'll have something on that should be paying me more than the loss on the short side.
Well, so but how are you defining your risk when it comes to? It sounds like you got some sort of hedge in place that we may not have enough time to work through today, but.
Well, what I'll do is I won't leverage according to broker leveraging allowances. I'll leverage according to the risk in the trade. So if the probability is 60% that the trade's going to work, I'll trade 40% larger position. If it's a 50-50 risk, I'll trade the smallest position that I can, which is usually not leveraged. So I'll do, if I'm trading a currency, I'll do a $10,000 position with a $10,000 account. If it's a 60 or 65% probability of at least a lead, then I might trade 20,000 or 30,000 on that trade. But in other words, the risk, the better the probability is for me, the greater I'll leverage.
Okay.
And I don't typically leverage more than 4 times the account balance.
Okay.
But at the same time, I'm on both sides of the market all the time.
Yeah. Okay. So
it's a hedge. Yeah.
Yeah, you're kind of hedging. So it's kind of a. I guess you hedge your bets on an answer too.
Well, I can't. Okay. Well, see,
no, give me a hard time.
What I could do is I could show you what happens. What typically happens is that the trade that if I have a long signal today, I won't get a sell signal in a currency for 2 or 3 or 4 days. So I might get a 50 or 80 or 100 point lead on something before I put the other side on, and then it falls back and I scratch on one side, and then I'll make money on the other. So I'm not really hedged the same way you would think hedged.
Okay.
It's based on the signal, and I look at the buy side and the sell side as if they were independent strategies. It turns out that from the standpoint of the equity, it appears like hedging.
Gotcha. All right, Greg, let's go to you. Same question.
All right. Hopefully my answer will be a little bit easier to follow.
Yeah, I'm sorry about that, guys.
No worries, no worries. It's always interesting to hear what people are doing. Now, because what we do is intraday, the last thing I want to do or I ever want to encourage any of our students to do is to stop and think about a position size before they take a trade. The methodology determines the probability. Right, so we have an overall probability. So every trade that you take should be roughly a 75% probability of winning. The first thing I ask all of our students to do is to go through a very specific video and exercise accompanying spreadsheets, etc., that says let's work backwards and see, based on the methodology, based on how many trades you're going to take a day, what your risk will therefore be. And you go through this spreadsheet and you enter all the information, and it spits out a number and it says, okay, this is how much you should be risking on per trade. And now before you go and take that trade, we go back to what we talked about at the beginning of the session, which is psychology, because I agreed with the comment, and I think that risk management is 100% psychological. And what I ask all of our students, and for myself as well, is you take that number, which is your risk on a trade, per trade, multiplied by how many trades per day, per week, per month, etc., and you take full knowledge and accountability of that amount. So if you're trading a $30,000, most of our commodities traders, they trade $30,000, $40,000 accounts. Let's say you're trading a $30,000 account and you're doing 5 or 6 trades a day. You take that number and you say, okay, worst case scenario, if none of my trades work out today, what does that look like? What does it look like for today, for tomorrow, for the week? At the end of the month, what's it going to look like financially, and can I live with that number? And that's when you get into the psychology that says, if things go terribly wrong, is this a number that I can live with? Is this a loss that I can, take accountability for? So I want, for myself included, and everybody who we trade and teach, is take full responsibility of that number. That having been said, what I tend to do and encourage others to do is work on between a 2 and 3% risk per trade, and don't stop and think about it. We're talking about intraday tradings. The opportunities pop up very quickly. You have to act on them. I can't stop and start calculating how many contracts I want to put on, or if this is a better opportunity than another opportunity. I have to just click the mouse and take the trade. So once you've done all this work and you've taken full knowledge, responsibility, accountability for what disaster can look like, then you factor that back into how many contracts I want to trade, and ultimately it should be somewhere around 2 to 3%. So you want to risk $400 on a trade. You back out the number. What does that look like on an account side? If you want to risk $1,000 on a trade, $3,000, and you just do the simple math. And one of the things that we also encourage is to overfund the account. A lot of traders get into trouble because they take a small loss and they say, oh, geez, I just lost $700 on that trade. This is a disaster. Yeah, it's a disaster because you're trading a $3,000 account.
Yeah, absolutely.
But the reality is you just put on a 10 lot, and it's, it has a notional value of whatever, $250,000, and you lost $750 on a $200,000 plus trade. It's not a disaster. You're just not properly funded.
Yeah, and that's one of the biggest problems I see is undercapitalization, and you're right, and that's very important, and that probably needs to be worked into the mechanics when I talk about psychology, because I like what you just said, because from a psychological standpoint, I just lost half my account. Well, if your account is $1,400, you lose $700, that could stress you out. But as you said, if it's a $200,000 account, then $700 one way or another doesn't make a big difference.
Right.
I fully agree. That's a great point.
Exactly. So I try to stay between 2 and 5%,
Okay.
and in that neighborhood. But keeping in mind, unlike some of the other guests here today on the panel, we're talking about being in one position at a time. You're in, you're out. We're not carrying multiple positions. The average trade only lasts a few minutes, so you can even go higher than that, and that's okay, as long as you've done that exercise first and taken full knowledge and accountability for what a loss can look like.
Gotcha.
So there you go.
All right, Glenn, let's go to you. What percentage of your trading account do you typically put into an individual trade?
Yeah, okay. Two variables here, and my mind has been expanded, and I kind of, by the responses, and I'm learning a lot here. As I perceive the question, trade size versus risk, they may or may not be the same, but
Right.
My explicit response to my response to the explicit question, as I understand it, speaks to trade size. So in my case, my max threshold is 15%. That's exposure in one market at one time. It typically is I use as a kind of a threshold kind of boundary level. But that doesn't always necessarily equate to risk. Risk is my tolerance, in terms of what amount of potential in a worst case scenario I'm willing to part with as a debit against my equity. Usually I'm going to max that no more than 2 to 3% in that range. Here more as a generic idea, how I think of that is I want to have a maximum risk such that determines my trade size that allows for extending the number of episodes so that I can do given a certain amount of equity. So I think the common theme that we're all seeing here is you want to have, given whatever amount of equity a trader has to begin with, you want to maximize the number of episodes of round turn opportunities so as to allow the statistics of the performance ratios stat of your methodology or your models to kind of approach as closely as possible. So that's the context with which I think of this. Any and everything I can do that serves to increase the number of entries. Now, whatever that risk is, that determines theoretically my exposure, which in turn determines if I'm doing FX, the number of lots, or if I'm or whatever instrument, if I'm trading the E-mini or whatever commodity or stock or whatever. But again, explicitly, my max trade size should typically never exceed 15% of equity. But my risk may be, is typically going to be much, much smaller, on the order of 2 to 3, maybe 3% in any one situation. But the idea, again, the generic idea is I want to have a risk such that I have enough possible entries so that I give whatever the probability or the performance ratio of my models is such that it allows for enough trades to realize that winning trade that will serve to offset any debits I might have incurred if it turns out the ace card hasn't shown up, but I've had a series of losses prior to, so that my survivability is sustainable.
Yeah, and I like what everyone's touched upon today is that there will be losses, and I think that the novice trader, and this kind of goes back to the psychology that I think Greg was talking about a little bit too, is that I think one of the biggest myths out there from the retail crowd is that they think that somebody has the magic formula, and like you're pointing out, Glenn, it's just a probability, and you're letting your model run, and you're running your model, and having the proper mindset, as Jason and Greg both pointed out, to follow your system. So I hear you on that.
It's all discipline to the method that puts the probability better than chance if you can get it.
Yeah.
In other words, if this is what I tell my guys that I work with, is I say that the way you perceive opportunity in the market has to be congruent with how the market provides it. So what that means is that it's an unknown. There's no way to know. So since there's no way to know what's the probability being of an accuracy in one direction or the other, and how well can you take that opportunity now? So you can't look at it and go, well, the market is rising, so therefore I'll buy it. Well, there's reasons why that might be right. What's the probability of that? If the probability is higher for a sell, then it might be better to risk more money on the short side than on the long side. So that relationship of understanding the perceived opportunity as a probability first, and then 100% discipline to your method, that's what will keep you in the game through a string of losses, and it'll also give you the ability to really leverage and plunge when the time is right. You know, crude slides under $30 a barrel. You can bet your rear end I'm not going to have a one lot on the buy side, because that stuff is not going to stay there. You know, I'm going to lever up if I can, because at some point it's going to reach a critical mass in one direction where the probability is above 90% of at least a lead. So if I can get a lead on it and have a big position on with a low risk, why wouldn't I do that? So sometimes that percent that we're talking about, and it all has to fit the model, there's times when that works perfectly and beautifully, but if you really want to swing for the fence, there's times when you got to use your psychology as a little bit higher of a priority. You know, you see what I'm saying? Like guys that
well, the only thing is I hear you, and I know what you're attempting to do, but I would caution the novice trader out there to swing for the fence on any one particular trade. So I kind of don't want to go there.
Oh, you're right. I think because we never know who's listening, and you know, professional traders that have been trading for, like in our case, everybody here I think has been trading more than a quarter century. We've got 100 years or more of experience on the table right here. They're going to see things a little differently than a novice would, and I would never tell a novice to lever up. I would never tell them that, ever.
Well, even though I might feel pretty good on a trade, and sometimes I'll actually have a gut feel. I'm often asked that, do you ever have a gut feel? And quite often, but I don't lever up too much when I have that gut feel, because I know it could always be wrong. I actually keep it pretty simple, and this is the actual spreadsheet from my trading service that I put up on the screen here. And I publish this every day in a video, and I have a delayed version which is free. So in about a week from now, you'll actually see this portfolio in the daily version. I do have a charge for the live version, obviously. I based every trade on a hypothetical 100K account just to keep the math simple. If your account's bigger, you would just put the number in here, and then I'll actually give you this spreadsheet if you're interested in it to track your own portfolio. Not you guys, obviously, but whoever's watching. And so based on a hypothetical 100K, 2% would be $2,000 risk per trade. That's $2,000 risk if stopped out. That doesn't mean you go out and buy $2,000 worth of stock. So in this particular case, I determined that my stop would be 8 points away. So you divide 2,000 divided by 8, and that comes to 250. And then I transfer that to this column as a trending loaf and a trading loaf. So you see this column, this row here is white, or gray now, I guess. That means that half of that position has been taken off. And then hopefully the second half will become a longer-term trend-following type of position. And that's sort of so I can have my cake and eat it too. So that's just a kind of a quick lesson on the position management along with the money management. And I do that by slowly loosening up the stop. So we're looking for a swing trade, hopefully over a few days, and I hate to use the word hope too much in this business. And then also, again, hopefully also a longer-term trade. And if that longer-term trade doesn't materialize, and a swing trade does, at least we got something off the trade, and I call it better than the poke in the eye. So again, the math, 2% of your account value if stopped out. So whatever that number comes to, you divide your stop. Like in this case, it's 4 points. So 2,000 divided by 4 is 500, and then for tracking purposes, I divide that into 2 lows. But the entire position is put on at once, and then we actually scale out of the position. And again, this is the actual portfolio. -1 is shorts. It didn't look quite as good last week because we did have a couple longs in here that we got stopped out on, but it looks a little bit better now that we're all short in here. And of course, you know, kind of gritting my teeth, waiting for that big bounce that you guys think is coming, because I know sooner or later it will. But again, keep it simple, and I just use 2%. We have some ancillary questions in here, but since we're running late, I'll save these for maybe next week. But there's some good questions. The question went out to if you were hosting the show, what would you ask the guests? So I think there's some really good stuff in here. So if you haven't read the report yet, I would encourage you to do so, and then add to those questions. See what you would like to hear, and then add to those on there. Okay. I'm going to go ahead. Thanks to everybody here. This was a great show. I always learn a lot. I always take a lot of notes from these shows. A lot of stuff to go look at afterwards. In fact, I'm going to pull that Canadian up as soon as we shut down here. One thing real quick, Greg, hang on the line just for a minute. I just had one thing I wanted to ask you about, something that's kind of non-related to what we're talking about today. So just hang on for like 2 seconds after. All right, David Cosbit, let me turn it back over to you. Thanks again to you, and thanks again to Timing Research for having me back once again this week. Thank you.
Yeah, well, we have a couple minutes left if everyone wants to do a quick closing statement again about their site. You guys?
I'd be happy to if you guys want to give me one more minute.
Sure, yeah. Tell everyone again about your site and what you do.
Okay.
Oh, yeah, I'm sorry. I forgot about that. Yeah, I'm sorry. We were running so late. Jason, you?
Yeah, thank you. First of all, I love being on here, and I meet so many new and interesting people, and I wanted to say thank you for having me on again and for making me a regular stop. For you guys that are brand new, I have a website you're welcome to visit. There's some free content there, and there's some pay-as-you-go content, and I'm always available as well. So if you got any questions about what I offer there or how I offer it or why it's important, you're welcome to shoot me an email through the site. There'll be a little contact me area. I'll be happy. Just consider me a friend in the business, and because you listened to the research show today, I'm going to go ahead and automatically send you some free videos that I have for traders. There'll be a little bit more on the newer kind of trader. Like a lot of times we get real high quality people that have been trading for many, many years on this show, but there's also a lot of new people. So my stuff is designed more to kind of, for this free stuff, is designed to be on a more general level, so you're welcome to it. If you don't like it, just delete it. But thanks for coming, and thanks for having me, and I'll look forward to the next one.
Oh, thank you, Jason. Okay, Greg, like I said, we ran so late, I forgot about this part of the show. Anything else you want to tell us about your trading, wrap things up, and
Sure.
TradingZone.com, your website?
Yeah, the TradingZone.com. If you're interested in active intraday trading, stop by the TradingZone.com. We'll get you some free videos explaining what we do, a little bit about the market profile approach to intraday trading, and you just leave with this. I'll leave you today with this one thought, suggestion, advice, whatever you want to call it, which is you come to these shows, you'll learn so much. There are literally thousands and thousands of ways you can trade or participate in the markets. To make a career out of it, you need to learn just one. Stick to it, learn it, become best friends with it, and really focus your energies and education on learning one thing that suits your personality. And I think you'll discover that it could be a lot easier than you thought if you remain focused. So focus on the one thing. And I'll leave it there. Thanks for having me.
Yeah, amen. It amazes me, people that can't do one thing and be successful, but they try to do 10 things or 100 things, and then they just count on the air. So amen to that. Glenn, let's go to you next. Glenn Thompson, PacificTradingAcademy.com. Anything you want to tell us about yourself, your website, your trading, the markets, or anything else?
No, I think it's been said. I tend, much of what Greg and Jason and you, Dave, have indicated, I'm kind of on board with. So I appreciate the opportunity again. I was figuring out, playing with my functional end here, trying to get the charts up, and I said I didn't want to lose you guys, so wanted to show you the structure from a wave standpoint for three markets: the stock market, the yuan, Chinese currency, and the dollar, to kind of see the intermarket correlation. Maybe next time I'll figure that out, but I didn't want to lose you. But always interesting, and I picked up on a lot of good things, especially that I think Greg mentioned the Canada correlation. So again, we're at Pacific Trading Academy.com, and I teach across-the-board technical analysis. I work with beginners, experts, and everything in between. So if you're interested, we'd like to have you take a look at our programs as well. So happy to have me, or I'm happy that you guys invited me again. And always a good learning experience, exchange of good ideas.
Always glad to have you, Glenn.
Yeah,
okay, I'm going to go ahead and wrap it up quickly here from my standpoint. www.davelandry.com. Again, I have a lot of educational material. I have an ongoing, I guess you call it actionable service, which I just showed you the spreadsheet from, and that's the actual live spreadsheet that we do track daily. And then I didn't scroll down, but the recommendations are below the spreadsheet. I do a weekly webinar every week. Dave Landry's The Week in Charts. If you go to my website, there's a countdown on the website. And also, if you poke around my website a little bit, you can get the link to my YouTube account, or just go straight to YouTube and look for Dave Landry. And I also have these channels liked in my YouTube, so maybe you can find me from there if you're watching the recording. And then the only other thing is I do have a newsletter, and lately I've been publishing about once a week. I publish it's become a fairly lengthy article instead of a short article every day. I kind of save them up and make one big, kind of like the lesson of the week or whatever I see happening in the market. And so you can check those out on the front page of my website or through the newsletter. I think that's it. Thanks, everybody, again for coming. David Cosman, I'll let you wrap it up. And thank you and Timing Research for once again having me host. Again, I had a blast. Thank you.
Yeah, thanks, guys. Great show. Just want to remind everyone to go to TimingResearch.com/reports, and you can download this or any past report there. Also, be sure to check out the survey at TimingResearch.com/current survey next weekend. And actually, you guys talked a lot about oil. The question for next week is going to be about the price of oil. So be sure to check that out. And just wanted to thank my guests again, Jason Jankowski of theliononline.com, Greg Weitzman of thetradingzone.com, Glenn Thompson of PacificTradingAcademy.com, and of course Dave Landry of DaveLandry.com. Thanks for hosting again.
Thank you.
Thanks for having me, man.
Thanks, guys.
See you next time.
Thank you.
Thanks, guys.
Great.